Can you minimize taxes during a market downturn? Hey, I'm Doug Ray, president and founder of the Wealth Guardians and the Ray Financial Group.
And I'm Brice Payne, and you've entered The Vault, the Wealth Guardians video series on all things pertaining to retirement planning. In this episode, we're going to talk about how you might be able to minimize your taxes when we are in a down market. Speaking of down below the screen here, we've got those like and subscribe buttons that you can click on if you want to catch future episodes of The Vault with Doug, Garrett, and myself. But let's go ahead and get started on this one, Doug. We all would like to pay Uncle Sam as little as we have to.
100%.
You've got maybe a little technique here that some people aren't aware of that we want to be able to use in certain situations.
Yeah, you know, what we're finding is we've got a lot of folks coming into us that have significant gains in some of their holdings, especially the market's really, since the market bottomed in March of 2009, been up and up and up and up. And it's had a couple corrections along the way, but people have got some significant gains in their portfolios. And those are long-term capital gains, meaning they've held it for more than a year. So a technique, and I'm going to be very, very simple with this. One technique to avoid having to pay capital gains tax is this. Let's say you've got a stock, ABC stock, that has a $1,000 gain in long-term. And you've got another one, XYZ stock, that has a $1,000 loss long-term. So what you might do is you might sell your stock with a capital gain because you want to rebalance that portfolio. It's gotten lopsided over the years with a lot of gains in there.
Or maybe we just think that that stock has seen its peak.
Yeah,
for now.
Maybe.
Whatever the reason is,
it doesn't matter.
Yeah, whatever the reason is, you want to go ahead and sell it.
But you don't want to pay the tax on the gain.
Of course we don't.
So what we do then is we take a look at XYZ stock. It's got the $1,000 loss.
Okay.
We turn around and offset that gain and sell the loss. So now we've got no taxes to pay.
It's a wash.
It's a wash.
Gain and a loss equals out.
Now, here's the benefit of long-term capital gains. Let's look at the tax rates. Let's bring this up.
Throw this up here. Okay.
Yeah, throw it up on the video screen so people can follow along. You can see there's 4 different filing statuses. I'm just going to go over married filing jointly.
Okay, so the second row there.
So if you have earned income up to $80,000, you actually have a 0% capital gains tax rate. So that gives you a lot of leverage there.
Nice, kind of like the standard deduction.
Yeah, really.
Okay.
But also notice the 15% rate. That kicks in at $80,801 and goes all the way up to $501,600. So that's going to cover 90% of the folks watching this video.
Okay.
But it's only at a 15% rate. That's still a lot better than maybe your 22 or 28% earned tax rate.
Sure.
So let's take advantage of these kinds of situations when we can. Now, here's another unique situation you can do when a market goes down.
Okay.
Roth conversions.
Yep.
When you convert your standard IRA to a Roth, that is a taxable event. Why not convert when the account value is down, say in 22, when it was down 20 some odd percent?
Right.
Go ahead and convert now. You're going to pay less conversion tax because the market's down.
Right.
And then once it's in the Roth, then you get to sit back and watch it appreciate again as the market goes up.
It can be in the same investments that you were in the IRA.
Absolutely.
Same stock, same mutual funds, whatever you have, right?
100%.
Now, Doug, one thing that you said here that somebody might have caught and wants to question is you said, well, let's go ahead and sell a stock that has a $1,000 loss to counter that stock that we had a gain.
Yeah, XYZ stock.
Right. And they might say, well, wait a minute, why do I want to realize that loss? Why don't I want to hold on to it and wait for that to have a gain? But there's a little trick that you can use.
Sure is.
Tell us about that 30-day trick.
So it's a 30-day wash sale trick. So what you do, if you like that stock and you want to hold it long time, but you used it to offset a capital gain, you wait 30 days, maybe one more day, just for accounting purposes.
31.
Yeah.
Baker's dozen.
And then you buy it back. So that basically is what's called the wash sale. You don't have to go back and take that loss you took and do away with it. If you did it within the 30-day period of time, that loss would not count.
You don't get to, Uncle Sam says, hey, look, you can't sell that stock for a loss, claim the loss, and then go ahead and buy the stock back the very next day. Doesn't work like that. But if you wait 30 days or 31, as Doug is suggesting, now Uncle Sam does allow you to buy that stock back. Presumably, except in some perhaps unique times, that stock price is not going to have changed too much in a 30-day period.
Most likely not.
So really, you didn't, on paper, you didn't do too much as far as you still own that stock and you bought it back for more or less the same price that you sold it for. So you got to claim a loss there that ultimately in the end wasn't really like a loss to you.
Exactly. And maybe it even goes down further. So you lowered your cost
price.
Yeah.
Yeah. Who knows? So that's a great little technique that we can use. You just have to wait the 30 days. And there's your answer. Well, oh, that makes sense. Now I know why Doug said to go ahead and sell something at a loss to offset a gain, because I can go ahead and buy that same stock back after 30 days and be starting all over again. You basically reset your cost basis.
And obviously we've been talking about taxable accounts.
Yes. Yeah. You can go into a whole different thing here with different types of accounts. Anything else to add to all this, Doug?
I think we got it.
All right. Well, don't forget again to hit these like and subscribe buttons down below the screen there if you want to catch future tips and advice from Doug, Garrett, and myself. This has been The Vault. I'm Brice Payne.
I'm Doug Ray.
Hey, it's Brice Payne with the Wealth Guardians. Thanks for watching our weekly series, The Vault. Do you know we also have a weekly radio show where we discuss all things retirement? You can listen to the Wealth Guardians radio show live on 94.5 WPTI in the Triad on Saturday mornings. But if you missed the live broadcast, you can also catch it on our YouTube channel or find us on your favorite podcast platform each Saturday morning. Make sure to subscribe wherever you listen so you can get notifications when we release new episodes. I want you to remember, good retirement plans do not create themselves. We'll talk to you soon.